Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, so ICA has released revision test paper for CA final advanced financial management paper, right? This is for the May 24 exams. So let us now go and have a look at the RTP, right? RTP is what we call it. Now, first thing that I noticed was it is actually looking far more presentable than any of our previous RTPs. It is looking clean, neat, and they have added some fancy colors, right? However, despite it looking neat, it is old wine, new bottle, right? I don't know how many of you have heard of this saying. Old wine, new bottle is basically same old stuff, just outside the dressing is different, that's all. So, unfortunately, that is what has happened. They have only added two things, which are two small case study based questions. One is from securitization chapter and second is from security analysis chapter. Just to give you a perspective of how MCQs could potentially be in the exam. But other than that, everything else is actually questions from P590. If you're wondering what is P590, probably you're visiting our channel for the first time or listening to me for the first time. P590 is a compiler that we give out free of cost. Soft copy is given free of cost on our website. You can search for P590 on our website, or you can order the book and we'll deliver you a hard copy of the book. Now this book basically contains 590 questions, hence the name P590. These 590 questions I have solved almost all of them in the class, right? And this contains questions of past papers, then past RTPs, then study material, then practice manual, then everywhere, mock test, everything comprehensive. And I have also taken some my own questions from CFA, like that, right? So it is a combination of all the questions that one is supposed to or required to solve if you are enrolling with us. It is given free of cost. The PDF book is given free of cost on our website, P590, and the hard copy, obviously you have to buy it, right? So every single question, I think except last question where there is a twist, all other questions are actually from P590. So what I will do is I will not explain the question, because I believe that directly giving you the solution in P590 is far better than actually me trying to solve it here. Why? Because I have already done it. The solutions are ready-made available. So let us see. Let us first solve the MCQs. MCQs is interesting. In this also there are some twists, right? Growmore Limited, an NBFC, is in the need of funds and hence sold its receivable to MAC Corporation, MAC Financial Corporation, MFC, for 100 million. So Growmore sold something to MFC. MFC created a trust for this purpose called General Investment Trust, through which it issued securities carrying a different level of risk and return to investors. So MAC did something for investors. MAC purchased something from Growmore. Further, the structure also permits GIT, which is basically the trust, to reinvest surplus funds for short term as per their requirement. MFC also appointed a third party, Safeguard Private Limited SPL, to collect the payment due from the obligors and passes it to GIT. It will also follow up on the defaulting obliger and, if required, initiate appropriate legal action against them. Okay, now what are the questions? It's a very simple case study. There's somebody who sold receivables to somebody, they're securitizing it, then they appointed an agent, and then they're basically, did some transaction, whatever that 100 million worth transaction. Right. So let us look at the questions that are given here. Based on the above scenario, answer the following questions. The securitized instrument issued for 100 million rupees by the GIT falls under which category? Is it a PTC pass-through certificate? Is it a PTS pass-through security? It's a stripped security or a debt fund? The answer, if you have attended our class, I have explained very clearly. Wherever you have a security in which the structure also permits them to reinvest the surplus funds for short term as per the requirement. That is, instead of giving variable returns, you give actually a fixed return to the investors. How do you give fixed returns? When your inflows are variable, you basically take those variable inflows and keep them in some kind of investments or debt funds or somewhere. And once those returns come in, every month keep giving the investors fixed return. That kind of a structure is called pay-through security. That kind of a structure is called pay-through security. Pass-through certificate is normal stuff. Whatever comes in, you are passing. Pay-through means you pay very fixed amount. Then in the above scenario, originator is dash. This is a very interesting point. Okay. So when you look at it, right, even when I first look at it, I actually thought that Growmore is the originator. But then after I read it couple of times, I realized Growmore is in need of funds and sold it to MAC. So first level sale has happened. Is this sale a securitization sale? No, it is not a securitization sale. It is just sale of receivables. Whereas MFC created a trust for this purpose called GIT, through which it issued securities carrying different level of risk. So MAC did all the activity, or MFC, what they call MFC. Right, MFC securitized the receivables. The one who securitized the receivables is the originator, not the one who actually sold the receivables. Right. In all our examples, we have learned that, I have a receivable, then I create a SPV, I create a security in that particular SPV and all of that. If I sell to somebody and that second person does the entire securitization process, they are called as the originator. So here the originator is MAC Financial Corporation and not Gromore Limited for that reason. The one who's doing the entire securitization process, the one who's creating securities, the one who's taking the step towards creation of securities is MAC Financial Corporation, who's the originator. Let us look at the next one. In the above scenario, GIT is what? GIT is the trust that has been created, so it is basically a special purpose vehicle. Very, very simple. In the above scenario, Safeguard Private Limited. Safeguard Private Limited is whom? They are the ones who are collecting the money, appointed a third party to collect the money. So they basically are receiving and paying agent. Okay. Then fifth question, this is a very interesting question. Which of the following statement holds true? When yield to maturity in market rises, prices of principal. Okay, they made a stupid mistake here. It is not principal, it is called principal. So I have taught this in security valuation bonds. It is principal. Okay, your school principal. Same principle is used for loan. Principal means I stand by principle, a value, ethic or something. Principal means the initial amount, or your school or college principal. So both of them have this same spelling. Okay. Anyway, keeping that aside, when YTM in the market rises, price of principal only PO securities tends to rise. So YTM, PO. What are they saying? This rises, this also rises. That's what they said, right? Second one, when YTM rises, this tends to fall. This is the second one. Third, what they say, when YTM in the market falls, the prices also tend to fall. Then when YTM in the market falls, prices are stable. Okay, they have given 4 options. Now which option is correct? See, remaining stable is absolutely wrong. So 100% that is not the case. Okay, and this is a very confusingly worded kind of a thing. So what happens with respect to yield and linkage to PO securities? You can look it up in T380. What is this T380 now? T380 is my theory compiler. So I have given 380 questions in my compiler where I have explained what are the potential questions that can actually be asked. So what is a PO security? What is an IO security? From securitization chapters also been explained in that. You can go and have a look at it. Right. The link for that P380 as well as T590 which I told you are available in the description. You can have a look at the description also. Don't worry about it. Right. Now in that, what happens is when the yield rises, people are not prepaying. See, when market rates increase and your loan rate is same, will you repay your loan? So if let's say you've borrowed money for a housing loan, you borrowed something at 10% and fixed rate. Market rate increases to 15%. What will you do with this particular loan? You will say, "Arey boss, I will not prepay. I will not borrow 15% and prepay 10%. However, if the rate falls, that is, I borrowed at 10, now market rate is 5. I'll refinance my loan. By what? By doing what? I'll take a fresh loan at 5%, 6% and then repay the own loan of 10%. So, in case of a security where only principal portion is available, as and when the interest rates increase in the market, if the PO portion has fixed interest rate, market interest rate increases, nobody will repay. If they do not repay, the PO will be paid on due date. If the PO is going to be paid on due date, if it is going to be paid earlier, obviously the market value will rise. So if it is going to be paid later, if it is all postponed payments are delayed, the present value of that particular PO only principal only security actually reduces, because first of all the payments are spread out. Market interest rate is also high. So the present value of all the future payments comes down. So the answer is when yield goes up, the PO security value will fall. So that is our answer is option number 2. Option number 2 is the correct answer. Okay, so this is a slightly confusing one, but otherwise, if you have read my T380, you will understand. If you have attended our classes, you will know it. Now coming to the next one, security analysis. This is also an interesting question. You are a financial analyst at a prominent investment firm and have been tasked with empirically verifying the weak form of efficient market. Please note this word, weak form. you are supposed to verify the weak form of efficient market hypothesis. Theory for stocks, for the XYZ stock index, a collection of diverse stocks. You decided to conduct these different tests, 3 different tests to assess whether the stock market follows the principle of weak form of efficient market hypothesis. Now, test 1, for the past 5 years, you collected daily price changes of the stocks in the XYZ index. You calculated the correlation coefficients for different lag periods and analyzed whether past price changes exhibit any significant correlation with future price changes. You considered price changes to be serially independent. The results indicated that most autocorrelation coefficients are close to 0 and statistically insignificant, suggesting that the past price changes do not reflect future price changes. So, you checked for autocorrelation, did not find any autocorrelation. Then, you further investigated the randomness of the price changes in XYZ stock index. Analyzing the sequence of daily price changes, you count the number of runs where price changes are consistently positive or negative. Upon comparing the observed number of runs with the expected number of runs based on randomness, you find that they align closely, supporting the idea that price changes follow a random pattern. What did you do? This is autocorrelation, this is a run test. We did problems on this in the security analysis chapter. To examine the efficacy of trading strategies based on historical price trends, you implemented a simple trading rule for XYZ index. The rule involves buying when the price crosses a moving average of 5% threshold and selling it when it crosses another 7% threshold. Over a period of testing, you computed the returns generated by the trading strategy. The results revealed that the returns are not consistently better than random choice, hence implying that the past trends do not reliably predict future price movements. So, what is this kind of test? This is a filter rule test. You set a filter, based on the filter you take actions. Every 5% I buy, every 6% I sell, something like that. After conducting the 3 tests, evidence supports the weak form of efficient market theory for XYZ stock index. You concluded that the past price trends do not reliably predict future price movements. So, past is not a reliable predictor of future. So, we have 3 forms, right? Weak form of market efficiency is semi-strong and strong. Strong reflects public and private information, semi-strong reflects all public information, and weak form, if it is at least weak, then it exhibits certain amount of randomness, which is explained. That is, if you do all these 3 tests, you figure out that they are random and they are not connected, or the data points are not connected. So, what is the first question? Based on the above information, test 1 is what? I already told, no? Autocorrelation test or serial correlation test. Very simple. What is test 2? Test 2 also we figure out it is run test. What is test 3? Test 3 is filter rule test. So, 4th question, friends. The filter rule test should not be applied for buy and hold strategy when behavior is predictable, behavior is dependent on past trends, behavior is price changes is correlated, or price changes are random. When price changes are random, this kind of a filter rule test or where you do a buy and hold and sell kind of a strategy, it will not work. So, the answer is the behavior of stock price changes is random. Answer is 4. When that kind of a stock changes happen, then this particular test will actually fail. Results of your studies support what? So, all these 3 studies, whatever are there, what do they support? They support semi-strong market, strong market, random walk theory, Markowitz theory. So, when I was actually explaining the question also, I highlighted 2-3 places certain things. Please come back and see. You are supposed to check for weak form. When you are checking for weak form, these are the 3 tests you conduct. When you are conducting these 3 tests, the results will be used for only for weak form. For a semi-strong or a strong market, the tests are different, right? So, using these tests, you cannot make a statement for semi-strong or a strong market. So, answer this and this is gone. This and this is gone. So, what else is left? Random walk, Markowitz. So, in quite a few places, you have seen the word random, where the stock price are random, right? Even the previous question, what we are giving answer is the stock price are random. That is what we are trying to arrive at. So, Markowitz theory is not related to this, that is more related to portfolio management. So, the correct answer is random walk theory, which is answer number 3 or choice number 3. Okay, now they gave interesting set of questions in MCQs, one should accept, but some of them are debatable. Nevertheless, they gave an interesting set of questions. So, most likely your exam case studies for MCQs will be in this range. I think they gave it just to give you guys a feel that your case studies may be like this. Will they be slightly more tougher? Probably. Will they be very, very tough? I don't think so. Right, this is the kind of case studies that they will give. They may give non-case study MCQs also, I don't know. We'll have to wait and see for when the syllabus comes out, because if you look at the BOS portal where they have given MCQs, and we have uploaded, by the way, all MCQs. I don't know how many of you are aware, on our app and website, AFM MCQs are available. They're available for free for a few more days. and you can actually access over 600 plus MCQs or something are there. A lot of them are independent MCQs, and we have also updated some case study based MCQs. You can go and check them for yourself. Right. So I fundamentally believe that the case study based MCQs what they're going to give in the exam are going to be in this style or this type. Okay. Now coming to more practical questions that they've asked. First question is derivatives analysis. Somebody is expecting a price movement. Based on the price movement, they did one buy one call, buy one put, and then if something happens to price, what is the gain or loss? This is exactly question number 5 in our options chapter. Go to T590 and go to page number 308. Okay, not the PDF page, the page at the bottom of the right hand side of the corner of the page. Okay, not on the PDF. PDF has pages because there are some extra pages, cover pages in the beginning. Ignore those. Go to page number 308, which is the page number printed on the book. Right? Options, question number 5. We have solved this in the class. This is what I was telling you when I said that RTP questions are old wine, new bottle. This has been happening for last 3 or 4 RTPs. I have actually been not solving any RTP, just highlighting the question number from my practical compiler. So please note that. Very, very important that you solve the practical compiler for you to get enough confidence. Then, price of ACC stock was 220, futures in same stock on same date is for March was 222, other features are so and so, advise investor to be course of action so that they can earn risk free income. This is almost same, there is a small number change. This is question number 4 from derivatives futures part and page number 277 at the in the particular book what we have. Right, this is the same page number even in the physical book, so don't bother. Then business valuation. This question given is the information of orange, grape and apple. Based on this, you are supposed to compute WACC, EVA, market cap and so on and so forth. This also we have solved. Question number 33, page number 518 of business valuation chapter. Then everything is like this only. Okay, foreign exchange exposure and risk management. JK Limited exported has export exposure of so and so, current spot rates of JPY and USD are so and so, forward rates are so and so, evaluate the expected loss based on estimated rates if the hedging is not done. Okay, make calculations in yen for up to 4 decimals. This is question number 39, Forex chapter, page number 371 in P590 compiler. Okay, then UK based exporter exports goods, exchange rates in London are so and so, spot rate, forward rate, deposit rate, loan rate. Justify your stand to choose money market hedge including steps instead of a forward contract. Use 2 decimals. Question number 44, Forex chapter, page number 376. Okay, then advanced capital budgeting questions. This is a new topic that has been added. Please be very careful. They will ask questions from this chapter for sure because this is the first attempt where this chapter is included. X Limited is considering new project following details, initial cost, selling price per unit, variable cost per unit, fixed cost, discount rate, tabulate the NPV of the project, does it represent the actual outcome, comment, and examine impact of 2.5% adverse variance, critically analyze the sensitivity analysis. This is question number 18, advanced capital budgeting decisions, page number 28 of P590 book. Then interest rate management. A and B intend to borrow $200,000 each in dollars and yen respectively for a time horizon of 1 year. The prevalent interest rates are as follows. They enter into a currency swap which is agreed that B will pay 1% over Y loan where later will have to pay as a result of agreed currency swap. Basically a currency swap question. Question number 23, interest rate swap chapter, page number 449. Mutual funds. There are 2 mutual funds, D and K, each having close-ended schemes and consisting of so and so. Their Sharpe ratio, tenor ratio, standard deviation is given. Tabulate the expected NPVs of both schemes. Advise which one they should choose. This is a question from portfolio management chapter. We have solved it in portfolio management because tenor and Sharpe ratio are given in portfolio management chapter. Question number 66, page number 225. Then the portfolio management chapter. You've got 2 companies with returns, their probabilities. You're required to comment on the risk and return of the individual share. Compare the risk and return of these 2 shares with the portfolio of these shares in equal proportion. Advise the proportion to formulate a minimum risk portfolio. This also Question number 14, portfolio management chapter, page number 174. Then security valuation. Mr. Amit is happy with investment in a company as it's paying good dividend. Last year it paid dividend of so and so. Currently its trading price is so and so. You are required to evaluate the market value of the share, PAT, then equity capital, a bunch of other data, per share data. Question number 37, security valuation equities, page number 106. Then international financial management chapter. This is a question which is slightly novel. Even then, it is based on question number 1, page number 450 of IFM, very similar to that, but IFM is one chapter which I would say is a googly chapter, especially when they give you questions where they require you to project a balance sheet and evaluate the project or evaluate the investment, where there is cross-border investments, there are inflation rates and all that. I would always suggest in exam, keep this question, even if you know it well, do it in the last. Why? Because these kind of questions tend to waste time. Okay, so please in exam, if you get an IFM question, solve it in the end. Don't solve it in the beginning. Even if you know it, don't solve it in the beginning. Leave 2-3 pages and go forward and come back and solve it. Don't waste time on this question. Here also in this particular thing, I will not like to solve this because there is no point in solving a question which is purely mathematical. Okay, so you can actually go through it, what they've given. The only change that they've given compared to question 1 is they have not given a fixed increase in revenues and costs. They have got differential increase in revenues and costs. That's all. Beyond that, there is nothing else. Everything is fairly simple. They've even given, decimal numbers and, calculations in crores, so on and so forth. Right. Then theoretical questions. One is succession planning is a good way for companies to ensure businesses are prepared to promote and advance all employees, not just those who are at the management or exec levels. Explain the above statement. This is a question from startups chapter. This is a new topic added in startups. New. So all new topics I have highlighted. So there is also a separate compiler, theory compiler as well as practical compilers which I have uploaded on my website, which are available free, which links are also given in the video of new topics. Theory questions, new topics, practical questions. Please take time, go through them. Then corporate strategy and financial planning, there is a new aspect. First chapter, first page, which is CFOs. The current scenario of globalization, growth in information and communication technologies, the responsibility of CFOs have drastically expanded. Explain. Right, so you have to explain this also. This is also a new topic. So please note, my friends, from these new topics, most likely you will get at least 10-15 marks, easily 15 marks of questions this first attempt, because it is the very first attempt. It can be in MCQ, it can be in theory question, it can be in practical question, easily. Just wait and watch. All the new topics combined will have easily 15 marks of questions. Okay, so this is the summary of the RTP that we have for May 24 AFM. Those of you who are from SFM and who are writing AFM now, don't worry. We have a separate course on bridge course on SFM to AFM, basically all the new topics, new aspects, AFM advanced capital budgeting decisions topic and so on and so forth. Okay, please visit our website, you can check, enroll, and of course do comment on this video, like, share this video, tell it to your friends, share it with them so it can be useful for them as well, and let us know what else do you want, and we'll be more than happy to assist you. Okay, chalo friends, start studying, all the very best. Your exams are in May. We don't know about the election dates, but ignore that and continue your studies. Okay, ठीक है, chalo, all the best.